other AT&T employees, and welcome. Thank you so much for spending a bit of your afternoon here with us today. I'm Sam, and I'll be moderating this presentation. I'll be behind the scenes. You'll see me dropping some links right above our heads there. Those are going to be some clickable links that you can use to get to our calendar and book an appointment with one of our AT&T focused financial advisors. You can also follow us on YouTube or LinkedIn or both. We post tons of AT&T related content each week, so we really think you get some value out of it if you considered giving us a follow. Today you're going to be hearing from Tyson Mavar, one of our senior financial advisors here, and he's very experienced in all of the AT&T retirement plans, and he'll be speaking to you on more of the emotional side of retiring and all of that, all of the things that are going into today's market and interest rates and everything else. Tons of information he'll be providing you today. I apologize in advance. He will not have time to answer your questions live. We try to respect your time and keep these as short as possible, while still making them as informative as possible, of course. So please ask those questions, and I will make sure someone reaches out to you afterward, privately through phone or email. And lastly, but very important, please be reminded we are not AT&T. We are not affiliated nor endorsed by AT&T. We are a completely independent group of financial advisors here, so keep that in mind as you're listening along today. And with all of that out of the way, we're going to jump right into it with Tyson Mavar.
Hello, everyone. Thank you for joining our webinar series this afternoon. My name is Tyson Mavar, one of the retirement specialists here for the Retirement Group. Today, we're going to be talking about behavioral characteristics of investors. This has been here in 2025, a bit of a volatile start to the year, and just reminds us of many of the behavioral flaws that we all go through as humans. So we wanted to talk about some of these characteristics and what we believe is important to remember when managing a retirement portfolio in order to avoid mistakes that can be potentially very detrimental to the sustainability of your retirement plan. So we always go through this checklist whenever we meet with a client for the first time, as well as when we review periodically going forward into the future. We want to make sure that we have considered all of these items on the checklist. And comfort and emotions are a big deal. Oftentimes, the best or at least most suitable financial decision is not always the most comfortable one. And managing our emotions can sometimes be difficult and lead to poor decision making when it comes to our money. For example, you may be very uncomfortable to retire when the economy is in decline, when your 401k balance is down, when interest rates are low. Sometimes, especially if you have a company that offers a lump sum option on your pension and you plan to take that, the best time to take that lump sum is when interest rates are low, because lump sum payouts are higher on at least defined benefit plans. And investments are cheaper, especially stocks. If you're presumably going to be investing a portion of your pension in the stock market, you want to retire when those stocks are as cheap as possible. Oftentimes it's difficult to do that. But on the other hand, when we see people most comfortable retiring is when markets are at an all-time high, and stock investments tend to be a little bit more expensive, maybe not necessarily the best time to retire. And there's many examples of that, over investing in your company's stock because of your comfort level with it. And we see many examples of this when we're working with our retirees and pre-retirees. Now, we want to understand the difference between risk and volatility. Risk, as we define it, is probability of capital impairment, especially permanent capital impairment. Volatility, while it can contribute to capital impairment, is not necessarily a good definition of risk, in our opinion. And volatility often create some good bargains, and we can benefit from volatility. We'll talk a bit about that today, but understanding your risk tolerance, your propensity for fluctuations in your portfolio help us as advisors, but ultimately understanding what's going to mitigate the probability of losing your money, of permanent capital impairment, and avoiding that at all costs. Ultimately, we would prefer to give our folks the most income possible that's still sustainable. And we can do that through maximizing your company benefits by understanding your pension, your health insurance plan, your 401k plan. We can also do that by understanding the tax code. And item 4 on this checklist, minimizing taxes and eliminating penalties whenever possible. Adding this to the retirement plan becomes really important. If we can increase your net worth without increasing your risk, we're very happy to be able to do that. And normally we can do that by being more tax efficient in the retirement plan. And ultimately developing a philosophy about your retirement. This is why it's important for your financial advisor, whoever you choose to work with, to understand maybe you and your spouse's goals, and build a plan that allows you to meet those goals tax efficiently, allows you to meet them without putting your retirement plan at risk of running out of money. It may be estate planning. It may be helping out special needs family members. It may be related to the things that you want to do, vacations, purchases, the hobbies that you plan to spend more time on in retirement. It's critical for me to know these things, at least when I'm working with my clients, so that we could be aware of maybe some opportunities that might exist that result from that philosophy about what's important to them in retirement. Now, we also, when we build a retirement plan, what we call a cash flow analysis, want to be aware of all the different sources of funds. What we think of as a three-legged stool, the most common source of funds: Social Security, a pension plan if your company offered one, and your savings, 401k being the biggest one for most of our clients, and making sure that these work together tax efficiently, and that you're selecting the options, whether it's lump sum versus annuity on your pension, the timing of your Social Security, the timing of your 401k rollover, and what you're doing in terms of funding a Roth IRA, for example. All of these are working together so that you get to keep your money as long as possible. You have income coming in for the longest period of time possible. And then also being tax efficient on the back end. If you don't spend all of your money, what is your estate plan, and how can we utilize things like trusts, various tax and distribution strategies to allow more of your money to stay within your family rather than getting eaten up in taxes, or being a liability that creditors can come after. We want to make sure that we understand your objectives fully so we can utilize these sources as effectively as possible. Now, when it comes to finance, there's two theories of finance. There's a standard theory that they still teach in most universities here in the United States. And there's a behavioral theory that is a bit newer. And we'll talk about both of these theories and some of the limitations on both. So the standard theory of finance assumes that investors are completely rational beings, that we always make decisions that are in our own financial best interests. It also assumes that we consider all information accurately and assess its meaning accurately when we're making decisions on whether to buy or sell a stock, whether to rebalance our portfolio, the timing of our retirement. It assumes that we're rational decision makers. Now, it also assumes that markets quickly incorporate all known information. The markets are efficient, in other words. And it also assumes that markets accurately represent the true value of all securities. Well, this behavioral theory realized the standard theory has some flaws. And what the behavioral theory of finance realizes that as investors, we don't always make decisions that are in our long-term best interest. We don't always make rational decisions. And we often make decisions based on imperfect information. We make decisions based on our emotions. We don't always do a great job of due diligence when we're making decisions on making changes to our investments. And what most people we see end up doing as a result of this is making no decision. But as you probably know, no decision is still a decision, but sometimes it's uncomfortable to make a decision because we feel like we're concerned it might be the wrong decision. Behavioral theory of finance also realizes that markets, although may be difficult to beat in the long run, oftentimes in the short run, there's anomalies that could create some good opportunities, good bargain purchases because maybe there's panic or people reacting to imperfect information, creates good bargains. But on the other side, there's also excesses that create potentially expensive mistakes. Companies that become very popular, and many market participants are willing to pay a very large premium for their shares of stock, whereas we would want to avoid those expensive mistakes and getting the best deal possible whenever we're purchasing, whether it's a stock, a fixed income investment, a real estate purchase. Even when we go to the grocery store or to the mall or doing shopping online, we want to get a good deal, the most value possible in any one of our investments or purchases. So the importance of understanding this behavioral theory, it allows us to understand ourselves and understand our flaws as human beings. If we understand these behavioral flaws, we are more likely to make better long-term decisions, whether that's picking a good day to retire, making decisions on reallocating our portfolio, the types of investments we add to our portfolio, helps us to stay the course whenever there's uncomfortable environments. This year, having a good example in April of 2025, a lot of negativity on the news sometimes creates an environment that it's difficult to stay the course. But also understanding that sometimes emotions of other investors create some good buying opportunities for us. And if we understand behavioral flaws, not only does it allow us to understand ourselves better, understand other people's, and take advantage of opportunities that are created by some of these behavioral flaws. Now, there are a handful of different behavioral characteristics or behavioral flaws that have been studied and we talk about on a one-on-one basis with our client. Here's a few of the common ones: loss aversion, narrow framing, anchoring, mental accounting, diversification, or more specifically, naive diversification, the disposition effect, hurting, regret, media response, and optimism. All of these create poor decision making on our part as human beings. But if we can understand these better, typically it's going to create a better decision making environment, especially when it comes to our money. So we'll go through a few of these here today. Hurting is a very common one from our clients and from novice investors around the country and around the globe. I'll zoom in on this study that was done by the Wall Street Journal. Many of you may use Morningstar as a tool for doing investment research, for picking mutual funds or index funds. What this study looked into was, you can see it in the top right corner here, for all of the Morningstar 5-star rated mutual fund managers. You can see in this example year, 100% of these managers were 5-star. You can see all of them are in red. Well, what this found out, this study, was that 3 years later, only 14% of 5-star managers remained 5-star managers. So if you're buying a mutual fund or investing with a fund manager based on their recent performance, chances are you are more often than not going to be unsatisfied with the results in a very short period of time. And another way to look at this is you can't trust these star rankings because you can end up chasing returns. We call this the herding effect, a behavioral characteristic wherein oftentimes we find strength in numbers and comfort in doing things that our neighbors are doing, our family members are doing, the masses are doing, but not always does that create a good decision-making environment. In fact, what we found in value investing is that oftentimes a company that may not be as popular, there's an overreaction. That company becomes available at a very good bargain. So sometimes it actually makes more sense to go against the herd, or what's called a contrarian perspective, because it creates good opportunities, and we can find great companies at very reasonable prices. Another interesting behavioral flaw is loss aversion. We do in our seminars, sometimes we'll do a scenario where we ask people, flip of a coin, 50% probability of winning or losing. In order to risk losing $10,000, how much are you going to have to be able to potentially gain in the case that you win? So heads or tails. What we find is that most people are not going to accept this risk unless they can more than double their money. In other words, they need better odds of winning than they do losing. Simply put, we just don't like to lose money. And this is exacerbated even more once we get into retirement and our human capital starts to deteriorate. In other words, we don't have the capacity to go back to work and work another 20 or 30 years career if it doesn't work out. Our risk aversion increases. Our propensity to take risk actually reduces. Now, this isn't always good when it comes to staying invested, staying the course in a stock investment, for example. And one risk that a lot of people forget to realize in a retirement plan is inflation, rising cost of living. So this is why most people that we work with need at least some stock exposure in their portfolio. Some of our clients, it's relatively low. Some it's higher, depending on their propensity for risk and how much of this risk aversion they actually have as an individual. But we just want to be aware of this because over the long run, stocks, at least they always have, done well. And we want to make sure in a retirement portfolio that we are not reliant on stock market returns for our short-term income needs. Money that we don't need for a while, it's probably okay to be invested in stocks. Money that we need soon, probably good to have some safe investments, whether that's CDs, money markets, fixed income investments like bonds, maybe annuities. Those are very common in a retirement portfolio because most retirees need money every single month to pay their bills. And most retirees can't just live off of the dividends that their stock pays. So typically, we're going to have some safer investments that we can pull from inevitably when our stocks are temporarily down in price. And it's going to help us to not panic. It's going to allow us to have a better retirement experience when we know that we're not reliant on the stock market being positive every single year, because we don't expect that to ever be the case. Now, I'll zoom in on this one too. Market downturns are inevitable. Stocks go up and down, but on average, they go up. What we found is that the stock market is positive more often than it's negative, and it is measured by the S&P 500. It's about 3-to-1. So if we have 4 years on average, 3 of those years are positive years for stocks, and 1 of them is down. Now, of course, looking at this, we look back to bear markets, and you could see that the bull markets far outweigh the bear markets, and this is why stocks go up over time. What is very difficult, if not impossible to do, however, is predict when we are going to go in these bear markets, both the magnitude and the duration of these bear markets. And unfortunately, especially when we're retired, it's difficult not to attempt to time the market. I have clients talking to me about this all the time, and they don't think that it's market timing. They want to sell their stocks, reduce their risk until they feel better about the economy, the stock market, until they have a better consumer confidence, as we call it. Well, it turns out inevitably what happens when we do this is we have to be right twice for this to make sense. And the likelihood of that happening is so low that it's just better to stay invested. So you may get it perfect. You may get out of the stock market or make your portfolio a little bit more conservative at the exact perfect time, the top of the market, we'll say. But what most people have a hard time doing is getting back in the market. And inevitably, by the time you feel good about the market again, you missed out on some of the best days in stocks. And this is why ultimately the average investor far underperforms the stock market in general. And this is done every year by a group called Dalbar. They do this study that compares investor returns to stock market returns as measured by the S&P 500 usually. And it's usually about a 2 to 3% per year decrease on the average investor because we allow our emotions to drive our decision making. So our hope is to, first of all, educate you to a point where you are comfortable staying the course inevitably when these down markets come around. And if anything, actually have the confidence to take advantage of good bargains that become available when prices in stocks temporarily drop. Of course, there's a difference between a cheap stock and a bargain stock. Of course, the cheap stock is correctly low valued, and the bargain stock something that may be incorrectly low priced, where we can take advantage and not only reduce our risk of future losses, but increase our chances of future returns. And then whatever hole we might find ourselves in as a result of stock market declines, we can climb out of them even quicker than we fell into them by being aware of the value and the bargains that are available and taking advantage of some of these bargains that are created by down markets. Now, I mentioned inflation. This is a big risk in a retirement portfolio, and this is why one of the main reasons we need to stay invested. And for most people, we need to have at least a portion of our portfolio in stocks. because our purchasing power is constantly deteriorating as a result of increases to the money supply and rising prices on the goods and services that we purchase as retirees. As it turns out, inflation is also correlated with interest rates. Typically, in a higher inflation environment, we're going to see rising interest rates. We certainly saw this in 2022 when interest rates went up to a very large extent. Mortgage rates more than doubled in about a year's time. We also saw interest rates on bonds going up, which, as it turns out, drives bond prices down. Interest rates and bond prices have an inverse relationship. So there is a risk not only to the value of the money in our portfolio eroding over time, there's also a risk to what we typically think of as the safe side of our retirement portfolio, our fixed income or our bonds in our portfolio, eroding when interest rates go up. So we need to be aware of this, and it allows us to look for different alternatives other than just a typical portfolio of stocks and bonds that will smooth the growth pattern and reduce our risk of permanent loss of capital even further. So our advice on this is stick with a long-term strategy. Put one together that is well thought out with a experienced advisor and ideally an experienced team so that you can have the confidence that you need to stay the course when times get tough. Try to turn off the news, especially when times have a lot of negativity on the news, because that'll often drive us to poor decision making with our investments. And don't feel like you need to react to every bit of information that you hear, because typically those that we're getting information from are compensated based on increasing our emotions, and typically it's through fear. We are more likely to tune in if we are nervous and worried, even if there's not necessarily anything to be nervous or worried about in the long term. That's what's going to drive ratings, unfortunately. Now, questions to ask your advisor, whether it's us or another group out there. Do they offer a complimentary financial analysis, and is it detailed? We will do this for you on a complimentary basis. We call this our retirement cash flow analysis, and we're willing to update that for you regularly, even before you become a client. Our hope is that we can develop a relationship and a track record before you retire so that you have confidence that we're a good fit for your business in retirement. And we can also help you in the last couple of years, hopefully, at your career, make some good decisions while you have the ability to do so, while you still have a 401k, for example. Does your financial advisory firm understand your retiree benefits, your health plan, your 401k plan, your pension plan, the distribution options related to all of those, the tax implications related to all of those? This is where a lot of mistakes are made. And it's likely if you're on this call, we already understand your benefits. If you happen to be a company that we don't have any clients from, we are happy to read your entire summary plan description and find pretty quickly, because we've been doing this a long time, all of the key dates, the timelines, the tax implications, and can educate you on things that you want to be watching out for, things that you ought to be concerned about when you transition from your company, so you don't leave any money on the table and you don't overpay in taxes when you're transitioning these benefits into income sources. What's the cost of service? Probably a pretty good thing to identify, not just because you want to have the lowest fee possible. It's possible that you may be willing to pay a higher fee for a service, but you don't want to pay for a service that you don't need. And ideally, you just want to be getting the best value for your money. That might be the lowest cost. If you're somebody that does all of this on your own, you could probably afford a cheaper arrangement, whoever your advisory firm is. If you're somebody that needs a little bit more help, maybe worth paying a little bit more for a company that's going to spend a lot of time on your tax and distribution strategy, your estate planning, your investment plan, because it's going to have time to communicate these things with you. Communication, we found, is a pretty key attribute of a relationship with an advisory firm, in part because that's how mistakes are made. If there's not frequent enough communication, it's possible you might make a mistake, or it's possible that your advisory firm could make a mistake by not knowing what's happening in your life because you're just not talking often enough. Now, what we found is 74% of Americans over the age of 50 don't have a written plan for their retirement. And this is absolutely unacceptable, folks, especially because a number of firms, including ours, will do this for you on a complimentary basis. So if you're interested in having us run this plan for you, it doesn't cost anything. Usually takes about 15 minutes to gather the information we need. And then 30 minutes to an hour to go over the analysis as well as answer any questions you have. So take us up on this if you've never done it, or if it's been over a year since we've updated your plan. We encourage you to do this, even if you're not a client of ours yet. Here's some of the reasons that we found people like working with us. We have offices throughout the country. We understand a number of different company plans, and we're willing to understand yours if we haven't worked with it yet. We have very specific knowledge in retirement income planning. All of our advisors are retirement specialists, which means that we will work almost exclusively with retirees. We've seen every mistake there is to be made, and we want to help you avoid making some of these irrevocable mistakes that can be a big detriment on the sustainability of your retirement plan. And if you'd like that complimentary analysis, just let us know. I'll have the phone number or email. You could reach out to us to get that. We also produce these webinars on LinkedIn, and here's our QR code to get onto our LinkedIn page to go over a whole host of different topics that we cover for retirees, some even specific to your company plans, most likely. So if you'd like to meet with me or one of my colleagues or just have some questions asked, you can email us at info@theretirementgroup.com. You can call us at 800-900-5867. You can even take a picture of this QR code if you have a smartphone. The one on the left will get you onto one of our retirement specialist calendar to answer your questions or to put together one of these analyses that we think will be very, very helpful in avoiding some of the common mistakes that we see most retirees and pre-retirees making with regards to their financial decisions. So with that, we'll wrap it up today. Thank you, everybody, for spending some time with us. Everybody have a good, safe rest of your week. We hope to talk to you very soon.